If there were only 3 rules to life, you'd probably want to know them, right? 3 rules to keep you alive, happy, and prosperous. Well, coincidentally, there are also 3 rules for trading. But before I tell you about these 3 rules, hit the like button and subscribe and make sure to join our Discord server. There, you're going to be able to react with hundreds of other traders and investors. The link is in the description. Now, after you learn these rules and embed them into your psyche, you'll be on the right path to building your wealth, and I guarantee that. These are the same rules that my mentor drilled into me for years. And who am I to argue with him? This was his mantra. And quite frankly, he made over $100 million in his lifetime resource investing. That's basically what these rules are all about, resource investing. Rule number 1, only take on asymmetric risks. Now, the asymmetric advisor focuses on speculating and investing in companies in the resource sector. The reason why we do that is because of the extreme boom and bust cycles, particularly in the junior miners and exploratory companies. They are the riskiest and, as such, the most rewarding companies on the planet to invest in. And we generally don't use leverage because that's the quickest way to lose or bust your account. Instead, we find asymmetric bets where we can invest a small amount of money in a company that has tremendous upside potential. That way, if we lose, it's a small loss and we can handle it. But if the company realizes the potential of that opportunity that we identify, then we can make a fortune. So asymmetric, small downside, huge upside. That's our focus. And quite frankly, that's what the newsletter that I've been publishing recently is called the Asymmetric Advisor. That's what it's all about. Asymmetric bets in the resource sector. Now, you might ask, well, can I add leverage? Leverage just makes it possible for you to lose more money or lose more money than you actually have. So don't do it. I mean, the whole purpose of doing these asymmetric bets is looking for this huge upside. You don't really need leverage with these types of companies. Just make intelligent, well-informed, and relatively small bets on companies that have that huge upside potential. You have to realize that commodities, which is what these resource companies are, that's their base thing that they produce, they go through these boom and bust cycles. So these companies also go through those same cycles, only they get exaggerated when they're smaller. You know, you can get them really cheap and wait till they grow up. They have huge swings in price. So what we do is we wait for these extreme swings to occur, and then we buy into extreme weakness or sell into extreme strength, or wait for that golden opportunity. It takes a lot of patience, but maybe there's going to be a merger or an acquisition, or have some I guess you would call it superior intelligence about what's happening with a particular miner. So that kind of leads us directly into the next rule. This whole idea of leverage, it's really a bugaboo. You don't need to do leverage in this sector. So rule number 2 is bet small. Now, this is actually the same rule I have in just about all my other courses that I've taught on in investing and trading, because it is without a doubt the number 1 rule that traders and investors overlook. They trade too large. And it usually starts with a good story from a guru or a can't-miss opportunity from a friend. So the trader or investor goes all in, commits way too much of their portfolio, or way too much of a particular bet or trade on a junior miner, and then they go bust. I mean, let's face it. Junior miners and exploratory companies are like startups. Most of them fail. As a matter of fact, it's probably the same kind of odds that you get with startups. Maybe 1 in 10 startups fail. You can think of a junior startup or an exploratory company in the same way. But you can increase your odds by doing your homework. And that's actually what the Asymmetric Advisor is about. I do that research for you and hand it to you on a golden platter. I guess you could say literally. But, that's how you increase your odds of actually winning in this type of sector. You do your homework and invest only in companies led by people that have top-notch reputations and a credible list of accomplishments. So the name of this game is to stay in the game long enough so that you can lay down some bets and hopefully come across those few big winners, those asymmetric trades. That's why we do small bets. We don't mind if we lose a little bit. We can lose a lot. But those big bets, those big ones, those big winners are so big that they wipe away all those small little losses. And so by betting small, that helps you stay in the game longer. And the longer you can stay in the game, the greater that your odds of striking gold. Right? And that's what we're there for, to literally strike gold. And of course, the easiest way to stay in the game longer and to keep under control is to have small position sizes. So we do two things in terms of our betting and our trades. We either speculate, which are relatively shorter investments, and then we invest for the long term, things that we're willing to wait for years, if necessary, for that company to grow into its own. Often the speculative plays lead into the investing plays. So when we speculate, we never commit more than 5% of our trading capital. And when we invest, we never invest more than 10% of our capital. Anything higher than that, then you're limiting your time or your potential time in the game. Like I said before, that's your goal, is to stay in the game. Limiting your position size helps you manage against the speculative worst-case scenario. And it also helps prevent you from being overweight in any one investment. Now, no one is so smart that they can pick the absolute bottoms or tops of markets. So we go a step further. When we're placing our bets, we do it in tranches. Tranches are pieces of the bet. So we actually divide that 5% speculative play or that 10% investment into pieces, into tranches. Maybe, depending on the size of your account, maybe as many as 5 tranches. And that's the whole idea. We can't really pick the top and bottom. So we deploy our capital in these tranches and we spread it out, trying to get near the bottom or the top, knowing that we'll never really actually catch that. But by spreading that 5% or 10% bet out into tiny tranches, we can improve our chances of getting somewhere near the bottom. It's kind of like dollar cost averaging in. This will also help us gauge the quality of the bet. It gives us more time to think about it as we're entering that bet. We might spread these tranches out over days or even weeks. And sometimes by the time you've committed maybe that first small tranche, you might find that you have to abandon the trade, or maybe even a better situation, just postpone until you put in that next tranche or the full commitment due to, say, some market shock or some news event, right? That way you don't get involved too early and make the wrong trade. Now, this just happened to me this year when the pandemic, the COVID-19 pandemic hit us. I had started investing before the market even went down. It went down like a rock. Fortunately, I only had a small tranche in for those initial bets. And then I was able to get much better positions when the market hit bottom. So that's really the whole idea behind betting small, and then on top of that, taking those small bets and then dividing them up into tranches. That is smart money management. All right, so that was rule number 2. Rule number 3, very important. Take profits often. If there was a universal truth with investing in any kind of natural resource, it would be that the opportunities, they come along all the time. They're plentiful. So there's no need to have this sense of FOMO, the fear of missing out. Don't worry about any particular trade. There's going to be another one right after that. Guarantee it. I mean, this is a busy sector. There'll always be another opportunity to profit. Don't get all attached to opportunities. Sure, take advantage of these opportunities, but it's more important that you have cash to invest. If your capital is tied up and you can't put it into another opportunity come along, you're basically shit out of luck. So if we get that big move and we're in a trade and you're making some great profits, take some of it off the table. You want to take some of that cash so that you have it in advance for the next trade that comes along. Then take enough off so that you pay for the cost of getting into that trade and let the rest ride. It's kind of what we would call a free ride. And conversely, if it goes against you, cut those losers short. You only have, it's a small bet. Get out of it quick. Don't worry about it. And that's the essence of managing asymmetric bets. There is no more powerful position to be in than to have plenty of cash to deploy when it needs to be deployed. So being nimble and unattached to your investments is perhaps the most powerful skill that you need to develop. Never wait around hoping something will turn around. This is why we look for asymmetric opportunities. When a trade or an investment doesn't work out, you drop it. Take a small loss. When it does work out and achieves a substantial profit, take some off the table, at least enough to cover your original investment. Book the profit. Take the free ride and take the remainder, the stuff that you've taken out, put it into your cash pile and just wait for that next opportunity. Wait for it like you just, this ninja trader waiting in the dark, waiting for that perfect moment, and then you pounce on it. That is asymmetric trading.